Hi, my name is Brittany Wallace, and today I will be showing you how I backtested the investment strategy saying that companies with low PE ratios yield higher returns. In order to get a random sample for this test, I pulled the S&P 500 from Bloomberg and used the random function in Excel. For this test, I used 1-year returns, 3-year returns, and 5-year returns. I used the PE ratio from the previous year end. For example, for my 3-year returns, I used returns from January 1st, 2016 until year end 2018. The PE ratio I used for that was year end 2015. For this backtesting, I used two different tests, one being the regression and one being the difference of means. First, we'll look at our results from the regression. For our 1-year returns, you can see that the PE ratio and the returns have a positive correlation. However, it's a very weak correlation. Our T-stat is greater than 1.65, so it is statistically significant. However, our p-value is only significant at a 90% confidence interval and a 95% confidence interval. If we look at our 3-year returns, we see a negative correlation. This would support the investment strategy saying that lower PE yields higher returns. However, our T-stat and our p-value both suggest that it is not statistically significant. If we look at our 5-year return, again, a negative correlation, which does support our strategy. However, it is weak, and the T-stat and the p-value show that it is not statistically significant. Next, we'll look at our difference of means test. In our 1-year, 3-year, and 5-year test, it shows our low PE returns being lower than our high PE returns, which does not support the belief in that investment strategy. But let's look at our 1-year returns. This does show statistical significance with a T-stat of 2.5. But if we go to our 3-year and our 5-year returns, our T-stat is well below the 1.65 benchmark. So it does not show significance for either of those time periods. In conclusion, I would say that the investment strategy that low PE yields high returns is not one that I would invest in. However, there may be some reasons to explain this test. People who invest in low PE returns, people that invest in low PE ratios hoping for high returns are doing so with the belief that that company is undervalued. However, a low PE could mean that earnings were just unusually high that year. Another reason that my backtesting here might be off is that the low PE strategy is used to hold long term. And in these tests, we've only used a 1-year, a 3-year, and a 5-year return. But if I was just looking at the test here, the regression and the difference of means test I've ran, I would not use the low PE as an investment strategy. Thank you. Have a great day.